So welcome to part two of our Inland Empire webinar this morning. This one will deal specifically with economic, socioeconomic, and demographic conditions and forecasts for this two-county region in California. And we'll start by looking at non-farm employment. What this chart shows is the total number of employees or jobs in the Inland Empire for various years from 1990 forward through our 5-year forecast. As you can see, jobs peaked in year 2007 with 1.270 million jobs. We've gone down quite a bit from there, and you can actually see this on this next chart here, where we've lost in 1 year almost 92,000 jobs. That is unprecedented in the Inland Empire, and it was certainly felt throughout every industry and every area of the Inland Empire, especially in construction, which was hit especially hard, as was manufacturing and some of those other more recession-sensitive industries that are stationed there. There are industries, however, that are growing and continue to grow at a little bit more rapid rate this year. Those include health services, biotech, and some of the manufacturing sectors that cover specifically renewable energy, biotech, and those things that are dealing with up-and-coming industries. We expect that this year, and we have lost jobs, we'll expect to continue to lose jobs through most of this year, but we think that by about fourth quarter this year, we'll see our first quarter of positive job growth on a 12-month basis. It's not reflected in the annual average for year 2010 because we're still losing quite a few jobs in this area, but we're losing them at a decreasing rate. By the time we hit 2011, we'll have our first annual period of job growth, followed by another economic cycle thereafter. You've heard me speak in these webinars what I think are the next economic drivers, not only in the Inland Empire but in California and on a national basis. And initially that has to do with the stimulus package. We've only spent about 25% of the stimulus package. It's really just beginning to be felt. About 50% of it gets spent this year. That really doesn't get felt until later on this year and next year. But it is increasingly being spent, and you can't pour in almost $1 trillion without the economy without having some impact. Thereafter, we have emerging industries, including various facets of the renewable energy industry, and others that are up and coming, medical, biotech, pharmaceutical, those that have to do with an aging population. Trade and tourism is also rebounding slightly, and we think that stabilizes. Exports are doing extremely well with a low dollar. And there is enough there in terms of existing and new industries that are poised for growth that we think it begins successfully a new economic cycle. And we think that begins in earnest the latter part of this year and into next year. In terms of housing supply, you can see that the annual level of construction activity for homes peaked in year 2006, and then it just absolutely plummeted. Year 2009 was an all-time low, and it's followed during year 2010 with an even lower figure. And this directly follows the patterns of permits that have already been established during year 2009 and the first part of year 2010. It also reflects the inability of builders to make money with unfinished land. They can make a margin on finished lots because they buy the lots and the improvements at a fraction of the original cost. They cannot quite yet do so with unfinished land, which simply means that it delays that supply pipeline a bit. And we're going to experience a few years, 3 or 4 years, with very, very low inventory levels. Now, you don't immediately feel that, because if you add to that pattern of construction, the inventory of distressed housing, which this is shown here by these darker bars, then you can see that year 2008, which was a very low supply year in terms of construction, was actually near an all-time high year once you account for distressed inventory, or some people refer to it as shadow inventory. Year 2009 is a big reduction, but it's still somewhat of an average or slightly above average year in terms of overall housing supply when distressed housing is accounted for. Not so for 2010. It gets very low. It gets even lower in 2011 and 12 and thereafter. And so even with distressed inventory, we're going to see some low supply patterns coming up. They're not quite here yet, but over time they become more pronounced. And the thing is there's very little in the development pipeline to replace that. And so those few builders who can build homes during the next few years, we think will do quite well if they're able to market homes at the prevailing market rates, price levels at that time. Their price or their market share should increase, and more market share should be attracted to them, partly because the competitive levels are so low. Here is our forecast for fixed mortgage rates. You can see that we had a little bit of a spike, but it's bumped up and down between about 5%, 4.7% and 5.5% during the past several months. And the anticipated spike that we had actually projected to occur in April and May, mainly stemming from the Fed reducing its level of involvement in backing Fannie Mae and Freddie Mac securities. Now that the private sector is doing that, we felt that that should justify a bump in mortgage rates. It did, but very temporarily. And now they're actually down quite a bit. They're below 5% again. We think that they bump around that level for another year, and then they begin to gradually go up in tandem with economic growth. Now this forecast is a bit lower than what we had forecast in a previous webinar, and it partly has to do with that better than anticipated reaction in the private sector taking over those mortgage-backed securities. Population forecast during the next 5 years in the Inland Empire. The reason I show this is it's the number of people or population growth by age bracket. That's important to understand because though there is healthy population growth in almost every age bracket, it's especially healthy in the 55 to 64-year-old range. So in other words, despite the fact that there will remain potential for development of all types of homes throughout the entire spectrum of entry-level move-up housing, the demand for move-down housing and retirement homes, age-qualified homes, will be especially intense once the economy begins to recover. That recovering economy will allow for released equity in coastal counties, and a lot of that equity will choose to flow to the Inland Empire. That's really the only way a lot of these households can take advantage of that equity wealth. If they move from a more expensive area, release that equity, and then place a portion of that again in a less expensive area. The tax situation favors that, so we'll see that flow of equity from the coastal markets to the Inland Empire, and that picks up as the economy begins to pick up, allowing for that increased equity flow. In terms of household incomes, during the next 5 years, we will be producing a lot of 100,000 per year plus households during the next 5 years, and that is conducive to home ownership. That partly mirrors the maturation that we're seeing in the population. That is the end of part 2.